Hi, everybody. So I didn't record it somehow, so I don't know how that happened. So I'm re-recording it, but fortunately I have the interest example. So again, we are looking at chapter 4. We are going to have something on Thursday, so bring your questions. We're doing pretty good. We've got a few little issues, but not bad. I'm grading away. So let's go ahead and do a screen share. And we are going to do, there we go. Okay, we're sharing this one. We're going to go to the full view. So we're going to look at some topics from assignment and homework 4. The first thing we're going to look at is something called depreciation. This is something that is relevant to businesses. This is why I'm discussing it. I'm going to show you how to deal with it. It basically is something that affects the cash flow that you're doing because it reduces your taxable income. If you can have depreciation, you deduct it. And I think sometimes people get kind of preoccupied with it. I have farmers that want to buy new trucks because they want to get this big depreciation the next year and reduce their taxable income. But the reality is if you're buying a truck, you need to do BCA analysis, and small businesses have a hard time doing this. So this is why I'm showing it to you. We love our small businesses. We love our local businesses. A lot of times they're small. Big outside businesses don't need much help, but our small businesses are challenged. They are a great source of employment. They grow our local economy. They're very interesting as far as having a better sustainability position. So that's why we're looking at this. So we basically see here that this company is going to buy a machine, and they're going to generate an income from that machine of $20,000 a year for 5 years. And then it says something like no salvage value, and they use straight line depreciation. Again, a machine wears out. So after 5 years, this machine has no value. That's what they mean by salvage value. You can't sell it. You can't do anything with it. And every year that machine sits on your books, it's worth less money. So accountants have to physically go in there and reduce the value of the machine because they're really looking at what assets do we have to produce profits. Those are the assets we need. So that's basically what they're trying to do, is value that asset, because if you have a $10,000 machine, you're expecting much different amounts of net benefits from it than if you have a $25,000 machine or a $50,000 machine. So accountants try to keep track of what the value of our assets are, or our investments that we use to produce things. Then we kind of get a feel for what kind of profitability we're getting on a ratio, like 20% profitability. 20% of the value of your assets is what your profits are. So this is why we're very concerned with depreciation, because it's really an accountant going in there and writing it down, and the government lets us subtract it. So let's just see how this works. And the firm has a 50% tax rate. So let's just see how this works. So first of all, how much did the machine go down in value? $10,000 it's purchased for. It lasts 5 years, so it goes down in value to $2,000 a year. There are other formulas you can use that are not the same every year, but I'm making it as easy as possible. I actually use a tax app, which is all calculated for me. My son and I invented it, so I don't have to think about this. But the government controls it. You pick a depreciation method, you figure out how much that thing goes down in value every year, and you can forecast the impact of that on your cash flow, on your taxable income, your cash flow, and then your taxable income. And so it kind of looks like this. We save $20,000 a year by buying this machine, revenue minus expenses. And it goes down in value every year by $2,000. That's not cash, right? So really, we're able to subtract it, but really our actual hard money income from this machine is $18,000. We pay $9,000 in tax, and because we bought this machine, because we got to have this $2,000 deduction that we subtracted, that reduced our cash savings by $2,000, we didn't spend any cash, we just were able to write it down. We are basically only paying or only getting income of $9,000. We started with 20, but we're at 9 because we accounted for the depreciation thing and the taxes we paid. So this is what's actually going to show up as our income after taxes, and then we have to add back in the depreciation. Why do we do that? Because it's a non-cash expense. We only use it to figure out our tax situation. Because a business is a private entity and they worry about their taxes. Remember last lecture we talked about, well, taxes go to the community. So we want to account for the taxes, get them out of the picture because it's not a benefit for us. We got to pay that out. We subtract that out when we look at the private benefits of this investment. And we are now at $11,000. So you can use this table, copy it. I'm going to post this and you can copy it and follow it accordingly. So we really have an $11,000 benefit each year for the private business because again, it's not a project, it's now a private business investment and we have to account for the impact of taxes. And now we have. Another type of option is if you have a machine, it costs you $10,000, just like a car. A Rolls-Royce, a Hyundai, they both provide transportation services. The question is, which one is cheaper to get the same transportation services? So if the owner says, well, this thing cost me $20,000 a year in cost for 5 years, how do we analyze that? Well, all we're going to do is figure out which machine is the cheapest one. And we're going to do that by looking at how much they cost and what their net cash costs are and the tax implications of those. Again, 5 years, straight line depreciation. So it's depreciating $2,000 a year and a 50% tax bracket. So our annual cash cost is this. You add back in the depreciation because that's a tax deductible cost. Before we had benefits here, but now we've got costs. So we add that back in. We get tax deductible expenses. We account for taxes at $11,000 and we get operating costs after taxes. Then we have to subtract back out the depreciation because we really didn't have any cash in that. We were just using it to figure out what we were owing from taxes. So the actual operating cost each year for 5 years of that machine is $9,000, not $20,000, because those costs are tax deductible. Now we have figured out the impact of taxes. And if we had two machines side by side, the Rolls-Royce and the Hyundai, we could actually calculate which one was cheaper to buy by taking the net. It's not really a net present value, it's really more of a present value of all the stream of costs. And again, you don't discount your zero costs, you still leave that one in there. And then you discount all the costs from the next years 1 through 5, bring that back to year 0, and you can figure out which machine is cheaper. This is very, very common for small businesses, particularly leasing and buying is one I do frequently for them. You lease it, you buy it, you still can deduct the mileage charge exactly the same, but which one is cheaper? This will help the business figure that out. So that's very important that we learn how to help our small businesses, because again, large businesses have huge staffs that can do this. So we don't. So the net cost is $9,000. So here's some new topics covered in chapter 4 that I want to talk about, a concept called working capital. So working capital is money that you need to keep in your checking account to pay bills. Most of us do not let our checking account go to 0. We keep a certain amount in there because we know that in a given month, we're going to have an X amount of bills coming in. So when you do a new investment, sometimes you do need to hold more cash in your checking account because there's more bills that will roll in. You get a new machine, maybe it's more electricity, maybe there's more parts you got to buy, maybe you got to do some training. So you got to pay more out-of-pocket costs initially each month. Doesn't mean the thing is not profitable. It doesn't mean it's not profitable. It just means that you need more cash to operate. It's really something that you just keep there so you can pay bills. If you don't pay your bills over time, of course you go bankrupt. But initially it's just what we call a liquidity problem. I'm able to pay my bills when they come in. And the requirements may change from year to year. They may increase or decrease. So it kind of looks like this. So year 0, you don't have a requirement because you haven't really bought the machine. But once you buy the machine, maybe you need $100 extra in year 0 and only $50 in year 2. So the first year you have to account for assembling this $100. Whether you put a minus sign in front of that because it's a cost, or however you get that assembled, you need to make sure that you have that extra $100, and it's going to sit there. It's not going to usually earn money in a business checking account. Then in year 2, then you get to free up $50. So you have a $50 benefit that comes back in year 2. And again, I'll take your minus signs where, you can put a minus sign here and then not one there, or you can put the minus sign here and not one there. But the point is to track how those cash requirements go up and down, because it will affect your net benefits year to year as you have to keep money aside without calling it a benefit. It's just sitting in your checking account being available. So that's really a cost because you're not making money on it. It's just sitting there. And then you alter it over time. So there's a question that asks about this, and it's pretty straightforward. So again now, lastly, we're going to talk about this one more time, is borrowing funds. Funds for a project can become from your own money or from borrowed money. And if you're borrowing money, then it requires that interest be paid. If you pay interest as a private owner, it's tax deductible. Again, why are we talking about this? Because we're separating private businesses out. So then the interest must be calculated for each year so they can figure out the tax implications of that. Because again, what was one of the difference between a project NPV and a private NPV? The biggest difference was that tax dollar paid by that private business that benefited the government. That flows out of the private investor's NPV. So we've got to figure it out. It's one of the big things that makes the project different from the private NPV. So we've got to adjust for that. Principal is the amount that you pay back as far as the balance of the loan. Like I borrowed at $100, I got to pay the $100 back. So it's not tax deductible and we don't really worry about it. For government borrowing, of course, interest is also a future cost. Got to come up with that money. So you have to have it every year to pay back those bonds or pay back those loans. Usually some sort of government instrument like a T-bill or bonds, you got to pay that back. If you don't have it, your government is eventually going to go bankrupt. And also you have to have the principal, but the interest is really what the investor is expecting. And that will really create a huge problem if you don't have that for them. But for governments, it's even worse because they need to make sure they have the cash flow to get the principal. So they can actually go bankrupt also, as Detroit actually did. So for the private owner, here's what you do. You borrow $1,000 and then in year 1, you pay back the principal, but that is not tax deductible. That's cash that you need, but it's not a net anywhere in your net benefits or net costs. It's just, you got to have $1,000. You got to make sure you have that cash. But this $50 is interest. So you multiply that by the tax rate and you can actually add that back because that is a tax deduction until you take the $50 and you account for what you're spending or what you're actually spending on the interest that's tax deductible. So the only real thing that shows up in your cost calculation is really this $50 plus what went for taxes. And then that will then give you a resulting net benefit, which accounts for the tax implications. You can figure out what tax is going to come out of there from the tax rate. That's how much taxes are going to come out. And the business basically only has to deal with the leftovers from that $50 interest expense. And they actually get a tax break that's equal to what they paid in taxes because it's tax deductible. So they're not really double paying. And now we can figure out what's going to the government when we come up with the referent group NPV. So that's very important. So I don't think we have a problem on this. We do have a problem that I'm going to show you on a spreadsheet. So that's dealing with principal and interest. So let me show you what that looks like. But the tax rate is basically reducing this $50 charge, just like it reduced back here, right here. It reduced the charge because we were able to subtract some taxes right here. So our operating costs actually went down. So our principal cost would not be $50, it would be less. It's the exact same principle. So that's what we do. And why do we do that? Because we need to understand the difference between the project NPV, the private NPV, and the referent group NPV. The referent group, again, a lot of times that's just the tax dollars that you get. So let's stop share that. And I want to screen share this Excel spreadsheet. So I want to screen share this Excel spreadsheet. Let's blow it up. Okay, so when you're actually trying to come out with these principles and interests, how do you actually do this? So let's say you want to enter here then your loan payments. How many loan payments do you want to make? You want to make 3. 1, 2, 3, and that's all, right? So you want to borrow $1,000 from the bank. Here's your interest rate. Here's your loan payments. So we can actually use this finance formulas to help us figure out what are the principal, what is the interest, and what are these actual payments. So let's look at what that looks like. Go to our formulas, finance. So we actually have in finance different formulas. Here's one. The interest payment. It tells you the interest payment for a given period for an investment. So it tells you how much interest I paid. We also have another one that's called, this one tells you the principal for a given investment based on periodic constant payments and a constant interest rate. So when you're doing loans, this will help you calculate it because some of you are going to get confused. And you also notice when you do your formulas, if you bring down this list and you click on one, let's just look at the payment, calculates the payment for a loan based on constant payments and a constant interest rate. So we have ways to do this where you don't have to do it yourself. And some of you are confused with this formula builder, but if you pull down the menu and click on one, then on to the right, you'll see an explanation. Let's go to PMP again so it will go away. PMP that actually explains to you what is going on. So it's very important that you do this because I don't think you guys are understanding it. So this is what it looks like. I want to get back to the side, so let me move this. So constant payment starting at the beginning of year 1. Here's our interest rate. Here's what we're borrowing, and here's our number of years. So let's look at this. Oh. Okay, so what this is an interest payment and a principal payment. So we add them up, an interest payment and a principal payment. And we can actually come up with, this is how much we're going to have to pay to get that thing paid back. So each year we're paying 402.11. Here's the interest payment, or the principal payment. Here's the interest payment. How do we calculate that? Let's not hit return. I think I have changed it and I didn't know. So let's close it out. Let's stop sharing it. Let's screen share it again. And there we have it. So you see here, this is the interest payment. So this one is the interest payment. And this one is an interest payment, and this one is an interest payment. This is a principal payment, this is a principal payment, and this is a principal payment. So I've added them up, and the principal payments come to 1,000, and the interest payments come to 206. And I figured them out using the IPMT formula for this one, IPMT formula, and the PPMT formula for this one, and the PMT formula for this one. So that's kind of what went on. And I'm going to load this spreadsheet, but I want to get this thing posted. So play around with these things and try to bring up this formula builder bar. That will prove very, very helpful. So let's stop the screen share and the recording.